Let's get the latest now from Devan Murugan on our money desk. And of course, we're still talking global recession. Those fears still hovering, Devan?
Yes, indeed, they are. I mean, lingering fears over a global downturn and a lack of clarity on the US-China trade front is keeping global markets down today. After yesterday's dismal performance, investors are dumping shares, heading for safer assets such as bonds and gold. And markets in Europe are down. The US is swinging at the moment, and some small recoveries in Asia, but not enough to actually change the scene. It comes as we saw that weak production data and growth figures from China and Europe yesterday. Here's a look at what happened locally today. The local market more than 1/3% in the red as the international fallout continues. Banks did surge ahead as the rand strengthened. But as you'd see in the next graphic, that real drag came from mining shares. Goldfields, by the way, at one stage down 10% after releasing seemingly good results. And when we look at the local currency, the rand did make a significant recovery today, about a percentage point up from overnight levels. But it means very little with the volatility at the moment. And analysts say with the pressure on emerging markets, that could swing. All right, Wayne Mccurrie from FNB Wealth and Investment joins us now for more on the recession fears. Wayne, thanks indeed for coming in.
Thank you.
Before we get to the recession, I just want to touch on the International Monetary Fund. They were here today for a briefing, and they confirming that, number one, South Africa has not asked for a loan.
Correct.
Number two, they don't think we really need one at the moment. Is that comforting?
Yes. Look, everyone knows our debt situation. Everyone knows Eskom. Everyone knows the poor economy. Everyone knows the problems at SARS and tax collection. So there's not new news to anyone. But we're a long way from asking for an IMF bailout. This was really just scare stories that did the market over the last week. If we don't change direction and start to turn the corner and go the right way, we will be knocking at the IMF, but that'll be in the medium term. It's not imminent by a long margin.
They did say, however, that our growth trajectory, our growth at the moment is declining like we are in a country in the middle of a civil war, and we're not.
No. Now, look, I mean, there's a lot. The one good thing about having such a poor economy is we're starting from such a low base.
Yeah.
You don't actually have to change much to get the economy, unfortunately, not to 5%, but to get it to 1.5% and 2%, quite frankly, doesn't require much effort at all. It is simply some policies must change. You know, we've got to inspire confidence, essentially.
Yeah. They did say, I mean, again, when we've been reminded about this time and time again, just look at your labor laws, look at what's happening on the visa side. I mean, these suggestions, recommendations coming up again, it's nothing we haven't heard of.
No, we've heard this all, and, you know, I think the government truly realizes it, but when you look at the enormity of their task, I mean, this is a massive, massive task to try and, I suppose, undo 10 years, maybe even longer, quite frankly, of essentially poor management, not just poor economic management, but just generally bad management of the country and of the civil service and of service delivery. I mean, it is a mammoth task to turn around, but as I said early on, there actually are some quick wins.
Yeah. All right, let's turn to these recession fears now. So we saw what happened yesterday.
Yes.
China telling us that its output production was the worst since 2002. We had some dismal figures in Europe, from the powerhouse in Europe, Germany as well. And everyone got scared, but I think there's reason too. Those bonds in the US also looked scary.
They're telling you something. The 10-year yield is at the lowest ever on record, below 2%. Now, the only true risk we have of a global recession is if President Trump continues down this trajectory of trade wars. If he backs off, if they get a deal between the USA and China, it is very unlikely that the world will go into a recession. But understand, the good years are behind us. The growth rate is slowing down. And this happened in the environment of President Trump starting these trade wars. So the world was already slowing down, and then we had these trade wars which massively exacerbated the problem. But if Trump backs off, the world should avoid a recession, because there's one seriously good thing in the world's economy's favor at the moment. There's no inflation. There's no excess credit bubble. There's a lot of things that are actually structurally reasonably good. In fact, you're more worried about deflation, quite frankly. So as long as we get resolution on this trade war, the world should be okay, and South Africa, after taking a beating, as well as all other emerging markets around these trade wars, should actually get quite a nice recovery. But of course, you're dealing with an unpredictable person who is essentially pushing a political agenda, not an economic agenda. These trade wars have got very little to do with what's actually happening in the US economy. This is all politics.
When before I let you go, I've got a few seconds. Anyone with investments offshore or even locally, should they be worried at the moment?
I think it is a case to be worried. We have got a few things. The rand, I wouldn't panic about the rand. I really don't think it's going to weaken that much more unless Donald Trump puts in trade wars. And secondly, our share market's actually reasonably valued, and I think that's one of the reasons why the banking shares were so strong today. They got so pummeled in the last month or two. Yep. Literally, they were down at valuation levels we last saw in 2008, when the world truly was in a recession, and a steep one.
Wayne, thanks very much indeed.